What do you think a beloved brand like Toys R Us and a whole bunch of other huge household names all have in common? The answer kind of peels back the curtain on one of the most powerful and honestly most misunderstood forces in the world of finance today.
Yep, you guessed it. They were all bought by private equity firms. And that one simple fact shows you just how massive the influence of this industry is, reaching from the top floors of Wall Street right down to the stores we all grew up with.
All right, so let's get into it. In this explainer, we're going to unlock the world of private equity. We'll break down exactly what it is, how it really works, and why it has such a huge impact on, well, pretty much everything.
Okay, first things first. We need to get our heads around why this is such an exclusive club. What is private equity really, and what makes it so different from all the other ways people invest their money?
So at its most basic level, private equity, or PE as you'll hear it called, is all about buying ownership in companies that you can't just find on a stock exchange. The whole point of the game? To chase really, really big returns, profits that are meant to completely blow past what you'd get from the regular stock market. But as you can imagine, with that potential for high reward comes some seriously high risk.
So how is this different from, say, buying a share of Apple or Google stock? Well, think about it. Public stocks are what we call liquid. You can buy or sell them in seconds. Private equity is the total opposite. It's incredibly illiquid. Investors are literally locking up their money for years at a time. This makes it a high-stakes game that's really only open to what we call sophisticated investors. Big players like pension funds and university endowments.
Now, a lot of people get PE mixed up with hedge funds, but they are completely different animals. Hedge funds, they're all about short-term trading in public markets, stocks, bonds, you name it. Private equity firms, on the other hand, play the long game. They take a hands-on role, buying companies with the plan to actively operate and improve them over many years.
And that brings us to venture capital, or VC. Now, VC is actually a type of private equity, but with some really important differences. VCs invest pure cash, equity, for smaller minority stakes in brand new startups. Traditional PE, as we're about to see, loves to use a lot of borrowed money, debt, to buy a majority or controlling stake in companies that are already mature and established.
So now that we have a feel for what PE is, let's take a look under the hood of the money machine itself. How are these funds actually put together? And, maybe more importantly, how do the folks running the show get paid?
So inside a PE fund, you've basically got two main groups of people. First, you have the general partners, or GPs. These are the fund managers, the ones finding the deals, making the investments, and actually running the companies. And then you have the limited partners, or LPs. These are the big institutions with the deep pockets, pension funds, endowments, the ones who provide almost all of the cash. The GPs usually have to put in a little of their own money, maybe 2 to 5%, just to have some skin in the game.
And the entire relationship between these two groups, the whole thing, is governed by one super important legal document, the Limited Partnership Agreement, or LPA. The best way to think about it is like the official rule book. It spells out absolutely everything, from how the GPs get their fees to what they can and can't invest in. It's the contract that keeps everyone's interests aligned, or at least it's supposed to.
A typical fund usually lasts about 10 years, and it's broken down into 4 distinct phases. It all starts with fundraising, where the GPs go out and get money commitments from the LPs. Next up is the investment period, where they actually go out and buy companies. After that comes the management phase. This is where they roll up their sleeves and work to improve those businesses. And finally, you have the exit phase, where they sell the companies, hopefully for a huge profit that makes that whole 10-year wait worth it.
All right, so how do the GPs get paid? This is where that famous 2 and 20 model you might have heard about comes into play. They get a 2% management fee every year, basically just to keep the lights on. But the real prize, the big payday, is the 20. That's a 20% slice of the profits, which is called carried interest. But here's the catch. They only get that after the fund has already returned a minimum profit back to the investors. That's called the hurdle rate, usually around 8%. And if things go south later on, there's even a clawback provision that can force GPs to give some of that profit back.
So that brings us to the engine room. How on earth do these firms generate the kind of massive returns they need to clear that hurdle rate and earn that sweet 20% carry?
The number one play in the private equity playbook, the absolute cornerstone of the industry, is something called the leveraged buyout, or LBO. This is it. It's all about buying a company using a massive amount of borrowed money, or leverage. And here's the really clever part. The PE firm uses the target company's own assets and its own cash flow as the collateral for all those loans.
So, how does the money for an LBO actually come together? Well, take a look at this. It's called a capital stack. The huge majority of it, maybe 60 to 80%, is just plain old senior debt from banks. Then you might have a smaller, riskier slice called mezzanine debt. And way down at the bottom, that little sliver, that's the PE firm's own cash, their equity, often just 10 to 40% of the total price. By using so much debt, they can amplify their potential returns like crazy. It's the ultimate high-risk, high-reward strategy.
You can really boil a successful LBO down to 4 main steps. Step 1, you acquire the company with all that debt. Step 2, you get to work and really try to improve the business. Cut costs, boost sales. Step 3, you use the company's own cash flow to start paying down that mountain of debt. And step 4, after a few years, you exit. You sell the company, which is now hopefully healthier and has less debt, for a big fat profit.
But here's something that's really changed in the industry. For decades, it was all about financial engineering, just being clever with the debt. But today, that's not enough. Real, actual improvements to the business, what the pros call operational value add, now makes up almost half of all the value they create. This means you can't just be a spreadsheet wizard anymore. You actually have to know how to run a business and run it well.
But, this whole high-stakes game of using tons of debt and making radical changes, well, it doesn't always have a happy ending. And that brings us to our final section, the real-world reality, the risks, and the big controversies of the private equity model.
And to really understand these risks, we don't need to look any further than the infamous 2005 leveraged buyout of Toys R Us. It's become this powerful and frankly tragic case study of what can happen when this high-leverage model goes horribly wrong.
And when the music finally stopped and the company filed for bankruptcy, crushed under billions of dollars of debt from that LBO, the human toll was just staggering. Over 30,000 people lost their jobs. That one number really shows you the devastating impact a failed LBO can have on real people and their communities.
This quote from critics of the deal really sums up the argument against this kind of thing. The view is that the company was loaded up with so much debt that it had no money left to invest in its stores or its website to compete with rivals. In the end, the financial strategy itself is what killed it.
And the Toys R Us story isn't just a one-off. As private equity has ballooned into this multi-trillion-dollar behemoth, its practices are raising some pretty big questions for everyone. Critics point to what they call value-extractive models that can lead to unstable jobs and lower wages. And as these firms start buying up companies in really critical areas like healthcare, the potential risks become everyone's problem.
And that really gets to the core conflict, the central tension at the heart of private equity today. On one hand, you have the industry promising long-term value creation through making businesses better. But on the other hand, the LBO model itself creates these incredibly powerful incentives for short-term financial moves that can suck value out of a company really fast, sometimes at the cost of its long-term survival.
Which leaves us with one big final question. As private equity just keeps getting bigger and more influential, touching every part of our economy, what is its ultimate role? Is it a force for good, building stronger, more efficient companies for the long haul? Or is it a machine that's just designed to break them down for a quick buck? That, right there, is the question at the very heart of the entire debate.